I don't think there's a single startup out there today that is worth the actual valuation that it states it's worth. Okay, most startups are losing money every month. What does that mean? If they carry on running the way they have, why are they worth money at all? They're just burning capital. The only answer to that question is yeah, but in a year's time, this could happen, or 2 years' time, this could happen, and 3 years, this could happen. So you're really just selling the future.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast, and today we have Taub with us. Judah is a co-founder and managing partner at Hetz Ventures. Previously, Judah served as head of data for Lansdowne Partners, a $20 billion London-based hedge fund, as well as an advisor to multiple young startups. In this episode, we talk about impact of public markets on private investing, how to think about startup valuations amid a downturn, sticky developer salaries, reason behind layoffs, investment thesis at Hetz Ventures, biggest learning of Judah's investing career, and lots more. So without wasting any time, let's dive straight in. Hey Judah, so good to have you on the VC10X podcast. How are you doing?
I'm good. How are you?
I'm doing good as well. And so good to have you on the podcast, and excited to talk about how founders can deal with the downturn that we're in right now, and how they should view their companies, how to manage valuations and all stuff around that. But we'll get to that later in the conversation. And to start things off, can we first have your story and how you started investing?
Yeah, so my story is I started off at a hedge fund, a fairly large, long, short discretionary hedge fund based out of London. I was there for a couple of years. I was in charge of data, so I wasn't actually an investor. I was part of a team that was investing all day. Saw how interesting and mainly varied it can be, and then found my way into venture, which is a place where, as a techie, I think you're able to be more on the decision side of making things and at the forefront. So really sort of got excited about that. And yeah, we started Hetz in 2018, and since then it's been quite an exciting ride.
Yeah, absolutely. That's an exciting story. And now moving on to the Forbes blog that you wrote about becoming a macro analyst, right? And you talked about how the public markets are performing affect the private markets as well, and how venture capital operates as well. So can you talk us into this connection that there is in the public markets and the private markets?
Yeah. So if I remember correctly, that piece that I wrote, really what prompted me to write it was just a few things that happened in the world. So the first being COVID, and then there was the war that started between Ukraine and Russia. And I wrote it before SVB, but all of these things and many other examples are examples of things that happen on a global basis, which has nothing to do really with early stage tech. But suddenly founders of startups feel how it does affect them. They suddenly feel that COVID's hit, and I'm not talking about the fact that they're in lockdown, but suddenly there is no capital. Everybody's afraid of investing, and suddenly there's tons of capital, and they were able to raise tons of money very easily. And then there's a war that starts on the other side of the world, and people are worried about investing in them. And so I started seeing some of our founders, and obviously many other founders that come through our offices, just waking up in the morning and monitoring macro events because they realize it might actually somehow affect their startup. So that was sort of like the penny drop, and it was just an interesting insight. And then coming from a hedge fund, which really looks at these big picture things the whole time, it became interesting to see, especially how sometimes people didn't react. So they understood these things could affect them, but just because the public markets crashed by 50% or in certain verticals 70%, they didn't necessarily see why their startup should be worth less. So just to your question, the connection I see is I think a pretty obvious one. It's that if you're now a startup, let's say you've just raised your Series A or B in a particular space, I think one thing you should do is monitor startups that are similar to you. Obviously, you want to be better and you might disrupt these companies or anything like that, but monitor the companies that are most similar to you who are currently in the public market. Because later stage investors are very often going to look at you and say, okay, you, in a good case scenario, might turn out like them. And maybe you'll even eclipse them at some point or disrupt them, etc. But when you're trying to look and model it, you're looking for a public public market company that you can somehow connect to these early stage startups and understand how this startup might be valued, how might it trade. And then what one has to do as an investor or a founder or anybody who really is looking at these early stage companies is try and understand how much money, how much time, and what risk, what chance does it have for the startup to get from its position where it is today to that later stage. So let's just give an example here. If I'm a cybersecurity company, and I'm just sort of making this up, very sort of broad round numbers, and I'm valued at $100 million, and I hope it to be a public market, big, successful startup in cyber one day, and suddenly my public company comps, so the similar companies to me in the public market, drop by 50%, it's got to affect me. Because yesterday, before they dropped, I was turning around telling investors, give me 300 million over the course of the next 5 years, and I might be worth 4 billion. Look at this company. I will be at least as good as that. And now I'm telling the same story. I might need more than 300 million because the market's become more difficult, but let's just keep it the same. 300 million. I might need more than 5 years, but let's just keep that the same as well. So I need 300 million for 5 years. And now I won't get to 4 billion because they're not worth 4 billion anymore. I might get to 2 billion. So that's got to affect me today. So one of the points of that write-up was to sort of try and show how these domino or backwards a domino can affect or should be affecting the way early stage founders think as well.
Right. Absolutely. Yeah. And that's a very interesting and valid take on how the public markets are impacting how private markets investing works as well, and how the companies operate and the valuations and everything related, basically. And another aspect that was covered in the blog post was about how the markets can fluctuate and the fundraising environments can go up and down. But the salaries of employees, and if we talk in particular about developer salaries, we see that they are always tending upwards. It's never that a developer goes for a lower salary or takes a cut because the markets aren't doing better or the funding isn't available to the company. So how do you think that is impacting the startup ecosystem, that salaries are actually remaining constant or increasing over time, but the availability of funding is not there or paused? And does this also lead to more of the layoffs that we are seeing these days because they cannot reduce salaries? So the only option left is to let go of your employees, right?
Yeah. So all very good points. What I would say is there is a challenge in particular with salaries, which is that they are sticky. And I'll explain what I mean by that. They're actually sticky or challenging in two ways. The first is when the demand for developers goes up, it's not like you can suddenly create more developers out of thin air. It's something that takes a while to create. It takes sort of a number of years to try and have salaries go up, to have young people decide to go into one field rather than another. You can't double the number of developers overnight, which you can do with other things sometimes in your company. You can spend more money and suddenly get more of them. But developers, there's really a finite number and they can't increase all that much. And as a result of simple demand and supply will mean that developers, especially over recent years, have had or seen their salaries increase quite dramatically. Actually, a parallel to that would be sort of like whiskey. So whiskey also went up in price dramatically because you can't age whiskey. I mean, there's other whiskeys that have come to market, but you can't do it faster than that. And then the second challenge with salaries is it's very difficult for CEOs to cut salaries across the board. Simply put, if you have 100 people in your startup, let's just keep it round, and let's say I rank them 1, 2, 3, 4, 5 to 100, and I wake up the following morning and say, guys, our startup today or our public company, doesn't matter, is today worth 30% less than it was yesterday. To make this sustainable, everybody needs to cut their salaries by 30%. I'll tell you exactly what will happen. Numbers 1, 2, 3, probably till 2025. At some point, maybe there's a few really strong loyalists there, but at some point over the next sort of couple of months, we'll say, come on, 30% cut. I was already getting lots of good offers beforehand. This is too much, and they'll get up and leave. And you'll be left at the end with the ones that you least want. So what people end up doing, and it's more fact the nature of these salaries than other things, is that they end up keeping numbers 1 to say 80, cut the bottom 20% that they don't need. They know deep down inside that sometimes they're paying people more than they should, especially for those numbers 30 to 80 that you've kept on the payroll, but you can't start cutting that easily. Some people's salaries and some people not, even though there are some companies who've tried to do that, but it's not easy to discriminate internally and cut back. And that's just the nature of salaries. I will make one comment here, which is I do think salaries, and especially the cost of writing code, will go down. So salaries, first of all, we've already seen some of it go down, especially since in the past, in 2020, 2021, you saw a lot of bonuses that have basically disappeared, sign-on bonuses that were huge, end-of-year bonuses, and all of that, which is part of somebody's salary. But it's an easier part to slowly get rid of and deal with. So that's number one. And then number two, the average coder is writing, as a result of a variety of technologies, more lines per hour, per person, which way you want to do it. So the cost to the company over time, especially per code line, I think will decrease, both because of technology and some of these market dynamics that is gradually coming into play.
Right, absolutely. Totally agree. And like salary cuts are certainly a very complicated issue that, like you said, if you cut back and then maybe they take the cut now, but then they'll go on the look and then maybe make a switch and then you're losing out on valuable talent. And but I've seen some companies implement that as well. We have one company in India. It's an edtech platform, one of the leading edtech platforms called Unacademy, and they recently announced a salary cut. I think it was 30% salary cut across the leadership teams, and just the leadership teams, and it was a permanent salary cut. It's not like they'll be back to the normal salary in about a year. It's like this will stay, and their next appraisal will be based on this one, right? And I think that's an interesting move. And I'm not sure what will be the consequences. Will these people leave over time? Were they given some other benefits by taking this salary cut, maybe SOPs or something like that? But yeah, certainly it'll be interesting to see. But I think the safest approach is probably to let go of the bottom 20% that you think you can do without, right?
I mean, I don't know this company, but I'm just curious to know how many of their employees are classified as leadership.
I'm unaware as well about that aspect. But I think they're saying leadership team, so probably those who are already paid lofty salaries. I think those are the ones taking the cut right now, but don't really have all the details of how do they classify that.
So I've seen that in a number of places. I think it's a very good approach to take.
Right.
It's usually, depending on what you classify as leadership, it's usually more symbolic. Because the grand scheme of things, and I'm in favor of it, with this smaller number of people, you can sometimes give some options instead of salary, etc. And it sometimes gives sort of a good morale boost because the rest of the company feels that they're behind us. But if you actually want to save on costs, I don't know again how they classify in leadership here, but if I go back to the 100 people that I was talking about before, if leadership is 5, 6, 7, even if those 5, 6, 7 are double the average salary, cutting them by 30% is unlikely to make such a big difference in the grand scheme of things.
Yeah, totally agree. Yeah, it's certainly an interesting thing to tackle around and something that's very important in these days, especially. And another aspect that you covered in that blog post is about valuations and how are valuations decided. So we talk about revenue multiples all the time, that what should be the correct revenue multiple for maybe different sectors. And then there are M&A multiples as well. And I loved how you contrasted the difference between what M&A multiples are being offered and what valuations are being offered by VCs, right? And there is a contrast between the two, and things kind of don't add up there. So can you throw more light on that?
Yeah. So I think there's 2 points here. The first one is, what should valuations or multiples be? Just full stop. I think in startups, and especially in early stage startups, so not sort of your pre-IPO or something where the business is really quite mature, the key point that sometimes I think is missed is the fact that as a founder or as a startup, you're really selling a future. I don't think there's a single startup out there today that is worth the actual valuation that it states it's worth. Okay, most startups are losing money every month. What does that mean? If they carry on running the way they have, why are they worth money at all? They're just burning capital. The only answer to that question is yeah, but in a year's time, this could happen, or 2 years' time, this could happen, in 3 years, this could happen. So you're really just selling the future. And I'll give you an example. Imagine two startups where everything is absolutely identical between these two startups. One of them is making $1 million today. The other one is making $10 million today. And now I promise you, as a fact, okay, there's no question here, that the one that's making $1 million today will be making $100 million in 3 years' time. And the one that's making $10 million today will be making $30 million in 3 years' time. Which company is worth more today? The answer is clearly this one. If you know everything that I said as a fact, then the one that's going to be making more money in the future is worth more today. So the key challenge that every entrepreneur has to try and sort of deal with is how do I persuade myself, my co-founders, my employees, my future investors, my current that the future looks like it's the 100 million rather than the 30 million. If I can persuade you of that, I might be worth more today. If you don't believe me, or if you think there's an extremely high probability that I don't succeed in that, or that would take a ton of capital or any one of these things, then I'm worth less today. So the whole point of multiples in a startup, I think, is a slightly sort of misused terminology. I think the point that so that's, I think, sort of maybe the main point. The other point that I was making, if I remember correctly, is contrasting M&As and fundraising. And it's a really interesting thing to do because it doesn't happen that often because most of this data is not public. But every so often you'll have a company, and we had two of these, that will get in parallel an acquisition offer and a fundraising offer. Now, that's a very small sample set, but I spoke to a variety of other fund managers who also have like 1, 2, 3. And as a pool, you can learn a lot from comparing the price an investor is willing to pay for the same company at the same point in time as an acquirer. And it tells you a lot about the health of the market. So if an acquirer is willing to pay more, it typically would tell you that like the VC or the venture sort of capital market is relatively healthy, maybe not too much money. The people that are making investments are probably making them below the price somebody would acquire them. So there's always value. If the price is the other way around, which is usually quite extreme, but something that we were seeing more of in 2020, 2021, and very, very early 2022, and we have roughly 10, 12 data points across a bunch of fund managers there, we saw the majority of them the other way around, meaning that an acquirer was only willing to pay X, but external people were willing to pay more to invest in it at that price. It means that these people are making a bet. I mean, they don't have all that information when they're making the bet, but ultimately they're making a bet that the day after they invest, the companies, if they had to sell, would be worth less, but they'll somehow make up for it, plus more to make their return. So I think within a small data set, it's a really interesting way to sort of test the health of the market.
Yeah, totally agree. And I love that approach as well. And now let's talk about Hetz Ventures, right? So what's your investment thesis at Hetz Ventures? And has your approach at Hetz Ventures changed at all in how you're evaluating startups now and how you were evaluating startups maybe back in 2020?
So what Hetz Ventures is we are an early stage venture capital firm. We're now investing out of our third fund. We're investing in very particular verticals, so DevOps, DevTools, cybersecurity, all sort of sophisticated software capital efficient verticals. We're a group of engineers that leads the team and the investment thesis, and we lead 90% of our deals at seed in Israel. The answer to your question is obviously a variety of things have changed, but I think the more interesting thing is that of the big things, not much has changed at Hetz. We were never in the bucket of writing term sheets in 24, 48, 72 hours. We're just not in that group of venture capital firms. We're in the bucket where we diligence carefully. We meet roughly 1,000 to 1,200 startups a year and invest somewhere between 4 and 6. There's obviously loads of startups that we've missed along the way because we weren't necessarily quick enough. We weren't willing to invest at such a high valuation, but we are very focused in what we do. We're disciplined in what we do. And as a result, 2020 and 2021 were years where we were scratching our heads and thinking, are we missing the party here? Where we're only still doing 4 to 6 investments a year? Are we missing the party where we're not willing to invest sort of off the back of an idea at an extremely high valuation? And I think over a long period of time, and obviously throughout cycles, we're likely to do justice to our LPs and to our founders, to be fair. So yeah, that would be the big picture.
Yeah, that makes sense. And now let's talk about an expert network that you have launched at Hetz Ventures, wherein there are more than 200 industry experts who are working at senior roles at some of the most reputable startups and companies, and they are present in your network. So what was the thought behind bringing all these people together, and how does that actually add value to your portfolio companies?
Yeah, excellent. So you've asked a few things here. So just the big picture one is the question we ask ourselves is, what exactly is our unfair strategy? How does this over time make ourselves more competitive, easier for us to do what we're doing? And how does this allow us over a long period of time to repeatedly do well for our startups and LPs? And for us, the answer to that question is to be focused. Focused on specific verticals, focused on a specific geography, and focused on a space that we think over a long period of time will also be a winning bucket, one that will naturally outperform other buckets. And we've picked that after a variety of analysis, and we built our team around that. A core feature is to be able to have a group of individuals who are experts within these domains, and this helps us on both sides of the coin. First, before we make an investment, we want to be able to pick up the phone to a dozen experts in this particular domain. And post-investment, we want to help our startups acquire first design partners, customers, etc. The thought behind the network was, since we're focused, we are infinitely better placed to do this than somebody who's a generalist. I know, without making an investment, what our next company that we're going to invest in is likely to look like. I can tell you things about the entrepreneurs before I've met them. I can tell you things about their go-to-market strategy before we've even had that first meeting, because we're focused on the type of startups we're looking to meet. And as a result, we have a privilege, which many other VCs don't have. We know what network we need to build well in advance of meeting these startups. So we put a pool of capital aside and a team that's now working full-time on upkeeping this network. And over the course of 3.5 years, we've built a network of, as you mentioned, 200 individuals who are at decision-making positions in global companies that are heavily suited to our network. When we survey our startups every year for what is the value they look for most, introductions to customers is always number one, whether it's to refine their go-to-market, whether it's to help them refine their onboarding processes, whether it's just to help them acquire paying customers. That is consistently year over year number one, and that is why we put a lot of effort behind this network.
Yes, absolutely. So the key value add here about this network is that you can get introduced to them and maybe pitch them your product and make them your user. Is that the key value add here, or are these experts also helping the founders with maybe their day-to-day operations? Or if they get stuck somewhere, then maybe they can reach out to an expert and seek help. Is that kind of interaction also happening there?
Yes, I would. So we track this every year.
Mm-hmm.
We're growing roughly 40% year over year with the number of introductions that we're making for our startups as well. So the startups, sometimes we want them as customers, but more often than not, and where the real value comes, is when you get on the call to a customer or a potential customer, but you have a friendly conversation and you're able to say, look, this is my actual product. This is what it actually does. This is where it's currently phenomenal. This is where it's good. And this is where hopefully in a year's time it will work. Do you think this is mature enough? How should I pitch this to somebody like you? And that is where the real value comes, because that's where the conversation can help you close 10 or 15 other people will give you that insight that releases a bottleneck. So yeah, we produce also sort of actual biz dev connections, but it's those conversations that are really helpful. I'll make one other comment, which is we're regularly talking to these experts without our startups. And the reason for that is we're meeting so many different startups that it's really hard to sometimes be able to pick which are the ones that you want to progress into diligence with. That's our product. Our product is our time and where we spend it, etc. So one thing we try and do is have a pretty clear thesis on the sectors that we're investing in because we're speaking to them quite often. And then when somebody walks into the room, or even just from the deck, we're able to quite quickly decide, is this one that we want to progress with, or one that we can save both of our sides time and sort of part ways very early on.
Right. So that means that you're also leveraging the expert network for conducting diligence on startup. Is that correct?
100%.
Great, awesome. I love how in so many different ways you're leveraging that network. And I wonder how does this interaction work? Are these like paid interactions with experts? Because I believe they're all very busy people. So do you have you partnered with them, or how does that work?
So here's the interesting stat. The vast majority, I would say well over 90%, there's no monetary exchange whatsoever. So much so that in some situations, people have asked us, do they need, or how much do they need to pay us for this service? Now, the reason for that, and it might be weird for like the entrepreneurs to hear that, or people who are used to speaking to entrepreneurs, is if you're, call it a chief security officer, or a VP R&D in a, call it sort of a mid-size unicorn, etc., or public market company, part of your job is to stay ahead of your game and make sure that if there's new technologies out there, you're aware of them, you're implementing them. It helps you hit your KPIs. Now, the last thing you want to do is spend all your time meeting startups all day. That takes up all your time and you don't know how to do this. But if you have a VC, which is heavily focused on the areas that you're in, and is able to, in a very short period of time, once a quarter, we typically speak to them for 20 minutes and say, guys, this is something we know that some of your competitors are starting to use. This is a technology, how are you aware of it? So without the startup, we will pitch, say, 3 ideas to them that they may or may not have come across. And they'll say, hey, you know what, that sounds really interesting. I'd love to meet that guy. Or they'll tell us, you know what, if you come across anything in this space, this is like high on my list now. And then we send them a few startups. This is actually a massive service to them too. So this network is really a win-win. And what we're doing is just creating, sort of as the middleman, trying to make sure that both sides are not wasting time. And you wouldn't believe how much time startups waste on it. And sometimes these guys in the corporations, they might do dozens of conversations before they get to one that's like a relevant one. So we're just helping facilitate those, and we get the added benefit of being sort of a fly on the wall and learning from both sides of the conversation of where technology and some of these ideas are trending.
Yeah, absolutely love it. And I love that kind of culture that we have in our ecosystem, that the senior folks are willing to help out and the ones who are just starting out with their experience. And it's like you said, a win-win for everyone, right? It helps the experts stay ahead in their game, and it also helps the newer founders to learn from the experience of these experienced folks, right? And now let's move on to my last main question before we move on to the rapid fire round. And this one is about, so Hetz Ventures started in 2018, and it's now manages over $300 million, right? So what's something that you wish you had known when you were starting out Hetz Ventures that you've learned now?
I would say, if I just pick one, I'd say how much you can actually enjoy it. So as somebody who's raising capital for a fund, it's maybe very similar to a founder. There's a lot of pressure. You're raising capital, you're making commitments to people, you're telling them this is what you think will happen, you're meeting startups, you're trying to build a funnel. It's a lot. And looking back, there's something really exciting about being able to just meet people who are telling you at the beginning of every single meeting, this is something that I believe in enough that I'm going to dedicate a huge portion of my career, my life to. And this is how I think the future might look. And you're doing this all day, every day. And so you get to sort of hear wacky ideas, meet different people the whole time. So yeah, somebody who likes to learn things the whole time and just hear different ideas, I think it's a very privileged position to be in.
Absolutely. Totally agree. Now let's move on to the rapid fire round.
Done.
All right. So the first one is, what are the sectors and regions you invest in?
We invest in Israeli founders, in DevOps, DevTools, cybersecurity, fintech, anything that's sophisticated software.
What's the typical stage of investment?
Seed, pre-seed, with the first money into the companies, and we nearly always lead the deals as well.
Great. So I loved reading all your blogs on the Forbes publication. They're all very insightful and give a very nice perspective on how things are. And I would recommend even our listeners to go and read some of Judah's blogs on Forbes as well. And I believe there are more on Medium. So I'll try to link them in the show notes below. Thank you so much for coming on, Judah. I love all the work that you're doing and the perspective you're adding. Thanks for coming on. Happy investing.